You have $80,000 left on the mortgage, and more than that sitting in the IRA. Paying it off in one afternoon is one of the most satisfying things a retired household can imagine doing. And in a lot of cases, it is the single most expensive thing they will do that year, for a reason that has nothing to do with the mortgage. I am Susan, and on this channel we run the numbers before anybody decides anything. So let me build the household, and then let me show you what happens on the tax return, because the tax return is where this decision actually gets made. Before I start, the usual and important caveat. I am not a tax advisor or a financial advisor, and everything I am about to walk through is an example built to show a mechanism, not a recommendation for you. Run your own numbers with somebody who can see your whole return. Here is our couple. Both 67, both retired, filing jointly. They receive $48,000 a year in Social Security between them. They take $20,000 a year out of a traditional IRA to cover the gap between the benefit and their actual spending. And they have $80,000 left on the house, with a payment they find annoying rather than frightening. They are not in trouble. They are comfortable. And the mortgage is the last debt they have, and they are extremely tired of it. So the question on the kitchen table is simple. Take $80,000 out of the IRA, wire it to the lender, and be done. Let me show you the year that follows. To do that, I need one piece of machinery, and I am going to describe it quickly because there is a whole separate episode about it on the sister channel. Whether your Social Security gets taxed does not depend on your income the way you normally think of it. It depends on a figure called provisional income, and it is your other taxable income, plus any tax-exempt interest, plus half of your Social Security. The thresholds are fixed dollar amounts. For a couple filing jointly, below $32,000 of provisional income, none of the benefit is taxable. Above $32,000, up to half of it can be counted as taxable income. And above $44,000, up to 85% of it can be. Those numbers do not move with inflation. They were set decades ago, and they have stayed exactly where they are. Now watch our couple in an ordinary year. Their other income is the $20,000 IRA withdrawal. Half of their Social Security is $24,000. So their provisional income is $44,000. $44,000. They are sitting exactly on the second threshold, right on the line in an ordinary year, doing nothing unusual at all. Now the year they pay off the house. They take $80,000 extra out of the IRA. Their other income for the year becomes $100,000. Add half the benefit and their provisional income is $124,000. They have not just crossed the second threshold. They have cleared it by $80,000. The share of their Social Security counted as taxable income goes to the maximum the law allows, and it does that on top of the $80,000 withdrawal itself, which is also fully taxable income in that same year. So the tax bill for that year has two parts, and most people only see the first one. Part 1 is the tax on the $80,000 they withdrew. Everybody expects that. Part 2 is the extra tax created because that withdrawal dragged a much larger share of their Social Security into the taxable column. Part 2 is the part that makes people call their accountant in March and say, "This cannot be right." And there is a third effect that lands a year later, so I want to name it even though I am deliberately not putting a number on it. Medicare charges an income-related surcharge on top of the standard Part B premium for households above a certain income, and it is assessed using your tax return from 2 years earlier. So a single enormous income year can raise your Medicare premiums for a year, 2 years after the fact, long after you have forgotten why. I am not giving you the thresholds because I am not going to quote a figure I have not verified for this year, and this is exactly the kind of number people get wrong on the internet. Look it up on the official Medicare site, or ask whoever prepares your return. So that is the cost side. Now let me be fair to the other half of the decision, because I do not think paying off a mortgage is foolish. What our couple gets in exchange is real. The payment stops. The required monthly spending drops, which means the $20,000 a year they were pulling from the IRA can drop too, which lowers their taxable income in every future year. And there is a thing that does not show up on any spreadsheet, which is how it feels to own the house outright at 67. I am not going to pretend that is worth nothing, because for a lot of people it is worth quite a lot. The question is not whether to pay it off. The question is whether to do it in one calendar year. So let me run the alternative. Instead of $80,000 in 1 year, they take an extra $20,000 a year for 4 years and pay the mortgage down aggressively rather than in one shot. In each of those 4 years, their other income is $40,000 instead of $20,000. Provisional income becomes $64,000. That is still above the $44,000 threshold, so more of their benefit is taxable than in a quiet year, and I am not going to pretend this version is free. But look at the difference in shape. In the one-shot version, they have a single year with $124,000 of provisional income. The whole $80,000 withdrawal is stacked into one 12-month window, and a Medicare surcharge may follow 2 years later. In the 4-year version, they have 4 years at $64,000, each one with a much smaller withdrawal, and each one likely to stay under the surcharge line entirely. Same total money, same eventual outcome for the house. Very different tax result, because the tax code is not a flat percentage, it is a set of steps, and jumping 4 steps in 1 year costs more than climbing 1 step 4 times. Before the questions, let me be honest about the 3 situations where I would not argue with paying it off in one go, because a channel that only ever says wait is not being useful. The first is when the money is not coming from a traditional retirement account at all. If the $80,000 is sitting in a savings account, or in a Roth, or is the proceeds of something you already pay tax on, then almost nothing in this episode applies to you. There is no income event, no provisional income jump, no surcharge risk. If that is your situation and the mortgage is bothering you, the decision is much simpler than people make it. The second is when the interest rate on the note is genuinely high. Every version of this arithmetic is a comparison, and if the interest you are paying is large enough, it can outrun the tax cost even in a single year. I am not going to name a rate that makes that true, because it depends on your bracket and your thresholds, but the comparison is real and sometimes the mortgage wins. The third is health. If somebody in the household has a diagnosis that makes the next 2 years the years that matter, then optimizing a tax return across 4 years is the wrong frame entirely. There are decisions where the correct answer is the one that gives you peace this year, and anybody who tells you otherwise is doing arithmetic on the wrong problem. I say this because the 4-year version I just showed you is not automatically right, it is usually cheaper. Cheaper and right are not the same word. And there is one more thing I want to put a flag on, because I have watched it go wrong more than once. If the payoff empties the accessible savings, then the couple has traded a monthly payment for a much thinner buffer, and the buffer is what stops the next problem from becoming an expensive one. A roof, a car, a medical bill that arrives before the deductible resets. If that money has to come back out of the IRA in an emergency, then they have created a second large income year on top of the first one, and now the same mistake has happened twice. So the real rule is not about the mortgage at all. Never let a payoff take you below the cash you would need if something went wrong in the next 12 months. Pay off what is above that line and leave the line alone. Now let me give you the 4 questions I would actually want this couple to answer before they decide. This is the part I would want somebody to hand my own parents. The first question is, what does the mortgage actually cost you a year, in dollars? I do not mean the payment, I mean the interest. The payment is mostly your own money moving from one pocket to another. If the interest is a few $1,000s a year, then you are comparing that number against the extra tax of a one-shot payoff, and quite often the tax wins the argument all by itself. The second question is, where does $1 more of income land this year? If you are already sitting exactly on a threshold the way our couple is, then the next dollar out of that IRA is more expensive than the last one. If you are well below every threshold, this whole episode matters much less to you. The third question is there any money that is not in a traditional IRA? A withdrawal from a Roth does not add to provisional income. Neither does spending cash you already paid tax on. If part of that $80,000 can come from somewhere that does not show up as income, the arithmetic changes completely, and that is the single biggest lever most households have and do not use. And the fourth question is, what does the payment actually free up? If ending the mortgage lets you stop withdrawing $20,000 a year from the IRA, then every year after this one is a lower income year, and that is a genuinely good outcome. But if you are going to keep withdrawing the same amount anyway, then the payoff bought you a feeling rather than a tax decision, and it is worth knowing that is what you are buying. Let me put the whole thing in one paragraph. Paying off a mortgage with retirement money is not a mortgage decision. It is an income decision, and the amount you take out in a single calendar year is the variable that costs you. Splitting the same payoff across 2 or 3 or 4 years usually costs less in tax, and the only thing it costs you is time, which is a very different currency from the one everybody focuses on. If you are within a year or two of this decision, do one thing before December. Ask whoever prepares your return to show you what an extra $80,000 of income would do to that specific return. Not a general answer. Your return, your thresholds, your state. That conversation costs almost nothing, and I have never once seen somebody regret having it. And tell me in the comments how much you have left on yours, and whether the money would be coming from a traditional account or a Roth. That second detail changes the answer more than anything else in this episode, and I would like to know how many of you have the choice. I am Susan. Run the numbers, then decide. See you next time.